Hey everyone, hope you're well wherever you are. I've made my first 2 investments in the Money Managers game. You can start making investments in your paper trading account as well. The plan was to start sometime in August. There's a link below to the Discord group for those who haven't joined yet. It'll be a bit of fun. Now today I want to go through an update on Markel's latest results, as it's a core part of my portfolio. And the reason why I'm doing any of this is because I found that the financial content online just felt a bit scammy to me, and I felt that if I show things like my entire stock portfolio, that this transparency, makes me vulnerable to criticism, but very responsible for what I say. I'm not into crypto, NFTs, or penny mining stocks. So here on my channel is my no bullshit approach to long-term investing and wealth. Now, let's go and dissect Markel's earnings, which will look ugly from an earnings perspective, but it's a trick to the untrained eye. Let me explain. Hey, so I've got Markel's report here that was released on August the 2nd, 2022. And what I'm looking for is I'm just going to look over the comparisons. They've got it all here split up nicely in this table between the quarter ended June last year and the quarter ended this year. So earned premiums for the insurance business has gone from 1.5 billion to 1.8 billion. That's great growth. That's about, I'm going to call that about 18, 17%, something like that. The Markel Ventures, their private businesses that they own, has gone from 1 billion in revenues to about 1.36 billion in revenues. Again, it looks like about somewhere between 15 and 20% growth there for the year. That's great. Okay, now this is really important, and this is why earnings per share is going to look really ugly, is because of what we call the net investment gains or losses here. Now this is unrealized. Now it's really important that you understand that this is unrealized. So Markel probably hasn't sold anything and realized any of the actual losses here. The portfolio has just fluctuated, just like my portfolio has fluctuated, and probably your portfolio has fluctuated a lot, probably to the downside as well. So in 2021, it was up. The net investment gain was 670 million in the corresponding quarter last year, and now it's 1.5 billion down, but that's just general market volatility and fluctuations happening here. But in America, I don't know why they do this, but they report it in their actual earnings, even though they didn't sell anything. So it's unrealized. This makes not much sense to me as a long-term investor. I think I kind of get why they're trying to do it like this, because they're just trying to figure out I guess the value of the business has decreased by this amount of money. So I guess they wanted to show that somehow in the earnings per share. Anyway, I don't think that's right. It should be in the balance sheet, but whatever. So comprehensive income. So that's, here we go. It's a net loss for the shareholders, but again, that's mostly because of this big loss here from the net investment loss. So that's where earnings per share has come in at negative $69 a share, where it was positive $57 a share last year. That's the $2.2 billion swing here that makes quite the difference. Now, combined ratio is a really good number to look at for an insurance company. This is an insurance metric. Anything below 100% means that they're writing profitable contracts. So they're essentially receiving more money than they have to give out. And this number fluctuates a little bit all over the place based on obviously like crazy events like hurricanes and earthquakes and fires and whatever catastrophes are happening. So this number does move up and down, but over a long period of time, if a combined ratio can stay under 100%, it means the insurance part of their business is successful. And that's what's going to be important for an insurance company, I can imagine. That's why this number is very critical. Markel have very disciplined insurance operations, and they are very consistently under 100%, which is a big reason why I invested in this company, was because they're very disciplined writers of contracts. Okay, book value per common share. So the book value of the business has gone from a little over $1,000 a share to about $900 a share. Obviously, that's because the investment portfolio has dropped quite significantly. Now, the common shares have actually decreased as well, so they've obviously bought back some shares here. Looks like I think this is in millions. So this would be 100,000 or so shares they've repurchased. So that's really good for us as the shareholder. It means our ownership stake is getting better. We're getting a bigger piece of the pie. So here are the highlights. Okay, earned premiums grew 17%. That's about what I was guessing. The combined ratio had gone up. So it was 87% from last year, and now it's 91%. And it explains a little bit here why. Driven by impact of less favorable developments on prior accident years loss reserves. So I think they go into a bit more detail of what that actually means a bit later. Here we go. The winter storm Uri was an issue for them. And the additional reinsurance costs attributed to the Russia-Ukraine conflict as well. So obviously some of their businesses had a bit of exposure there, and the reinsuring insurance companies has gone up in value, in price, I assume. So there you go. There's a bit of an explanation there. Net investment losses reflected a substantial decrease in the fair value of our equity portfolio, resulting from significant declines in the public equity markets. Okay. Growth in operating revenues for our Markel Ventures operations did well. Okay. Comprehensive loss to shareholders for the quarter and the 6 months was a result of the unrealized losses on our fixed maturity and equity portfolios. So their investment arm of the business, they're telling you why there is a loss. Okay. Goes into a little bit more details here. Essentially, it's going to talk a little bit about within our investment engine, our results were impacted by the sharp decline in the equity markets, as well as rising interest rates in the bond market during the first half of 2022. Given our focus on long-term performance and investing discipline, we are confident in the durability of our portfolio and understand that periodic volatility is to be expected. That's what Tom Gaynor said. So that's all we could really expect from an investment portfolio. Yes, there's going to be periodic volatility. You've got to expect it. This 3-engine architecture, they call it here, the investment one's gone down, but the other two have gone up. Hence, it makes a really solid business. We believe our financial performance is most meaningfully measured over longer periods of time, which tends to mitigate the effects of the short-term volatility and also aligns with the longer-term perspective we apply to operating our businesses. We generally use 5-year periods to measure our performance. So over the 5-year period ended June 30, 2022, the compound annual growth rate in book value per common share was 7%. And over the 5-year period ended June 30, 2022, our share price increased at a compound annual rate of just 6%. Now, the reason I find this really interesting is because, well, this book value per common share actually historically has been growing at around about 13%. So the last 5 years has actually been a very weak period for Markel. There's been I think it's really come down just a lot in this quarter and this 6 months where the investment portfolio has really declined quite significantly. I think if you didn't have the investment portfolio, I think the book value per share would actually be closer to 12 or 13%. And the share price is increasing at a compounding rate of 6%. So the business is actually growing faster than the share price is growing, which means there's going to be we're getting more value essentially. So you would think the book value per share and the share price should grow at the same time, but if there's a bit of a disparity, it will close at some point. So I think it's a good sign that the share price has not kept up with the book value per share. That gives hopefully the investment more opportunity to grow faster in the future. And here is that investment portfolio. So now, there's actually a lot of companies. Look, I'll scroll down and just show you how many there are. Looks like there's over 100 there. So there's a lot of diversification here, which you might think maybe is not so good because, where are you going to get? You're only going to follow the index here with such a diversified portfolio. But it's actually got quite a lot of concentration in the top sort of 5 to 10 stocks here. So the top 12 stocks actually make up about half the portfolio. So that's actually relatively concentrated, I think. And Berkshire Hathaway is the majority, the biggest position here. And they've got, looks like, 13, nearly 14% of the entire investment portfolio is in Berkshire Hathaway, which, is a pretty interesting investment in its own right and a pretty diversified asset as well. So you've got other companies here that you're very familiar with. We've got Google and Amazon and John Deere and Home Depot and Walt Disney and Visa and Apple and some very solid companies here with I think it's a very solid portfolio that Tom Gaynor has built, and I have no issues with this for the long term. So I keep my buy prices and intrinsic values for Markel and lots of other businesses updated in my monthly e-magazine. I use Interactive Brokers to do my investing, which is the safest of the brokers. Plus, don't forget about the Money Managers game that you can join and see whether you have what it takes to manage money. All of these things are in the description if you want to find out more. Now hit that like button for me to see if going through the report like this is of any interest, and I'll see you next week.